Hi, I'm Jesse. I'm a CFA. Today's inspiration for the video came from this particular YouTube video I came across where Jeremy Grantham, he's a billion-dollar investor, founder of the GMO asset management firm based in Boston. He covered a topic that you've probably heard a lot about lately regarding how expensive asset prices are as of late. He delved into how he believes this is actually the most expensive market in U.S. history. So this video here that I came across, and I wanted to expand on the theme that he was touching on, assets being exorbitantly priced beyond any rational valuation metric that would be used as in traditional finance. Um, he mentioned as an indicator for how expensive the market is, he used what's called the all commonly referred to as the Buffett indicator, which I'll get to in a moment. Essentially, it's the broad U.S. stock market divided by GDP. When it broaches 200%, that usually is a sign that things are becoming a little too exorbitant in how they're being valued. And I'll get to a graph on that, but just wanted to expand on his theme. I wanted to specifically do a deep dive on an AI company because that's one of the main reasons, if not the reason, that we're seeing such ridiculous, we shouldn't say ridiculous, but such extreme increases and rises in stock prices lately. There's the hype behind AI, and one of the companies that you'll hear about, semiconductor companies and memory chip companies, AI companies that you'll hear about. Micron is one name, and I'll do a bit of a deep dive on Micron. And I'll try to value it and use that as an example for why someone like Jeremy Grantham might have a point as far as things being a little bit unrealistic. So, as mentioned, Jeremy Grantham touched upon this indicator, Buffett indicator. It's a market cap to GDP ratio. Warren Buffett has referred to it as, or uses it as one of the only technical indicators that actually hold sway in his investment decision making. In this case, the Wilshire 5000 index is the broadest measure of the U.S. stock market, more broadly than the S&P 500. Uh, the market cap of the Wilshire 5000 to the U.S. GDP ratio. You can see here throughout the years, since the 70s, hovering around 100% is more or less the norm historically. As of late, we've seen since since the financial crisis, we've seen an uptick since 2010, 2009, all the way until the pandemic era, where you'll see um, things approaching 200%, and then with the AI boom most recently, in the far top right corner, we're actually well beyond 200%, approaching 250% as a ratio, which is cause for concern. It's just given how elevated it is, this metric is, historically speaking, regarding just how expensive the overall stock market is. I'll take a look at Micron as a potential insight to, as a micro example for why this might be the case. Here is the definition for this ratio. Pause the video and take a look at that. But next, I'll move on to a bit of a deep dive on Micron, and I'll give my opinion on this. Okay, moving on to Micron. Micron is a global leader in the semiconductor space and the only major memory chip manufacturer in the US. Moving to some valuation ratios, starting with gross margin. What we'll see here, just how cyclical gross margin can be regarding Micron. So as far as determining a risk element to any discounts that we want to include. um, you'll notice as revenue rises, um, gross margin fluctuates dramatically with the ebbs and flows of the business cycle, suggesting Micron is a bit of a price taker in this regard and is subject to volatility in the economy. Moving to operating margin, most notably from this graph, I, I noticed the consistency in operating costs across the board, um, despite fluctuations in revenue. So with that being said, um, there's significant operating leverage. So if revenue goes up, the company benefits, but if it goes down, as you noticed in 2023, there's significant downside. It stays remarkably steady across the board. Um, so moving on. Then we have free cash flow. So for this, we will be looking at 2025 cash flows dropping to a meager 4% compared to 2022. In large part, this was due to the dramatic increase in CapEx that we noticed in 2025, um, doubling since 2023. That's part of the necessary AI data center build out that CBC companies like this take part in. Um, so with that, their free cash flow has taken a hit, and it's sort of laid out pretty starkly in this example. So that may be going forward a drag on the free cash flow of this company. In the future, should mention all figures here are in millions of US dollars. So, for example, capex in 2025 was 15.8 billion, according to 10K annual statements. Okay, and next we have receivables turnover, slight dip from 2021, 2022 to 4.71. This suggests the company to maintain its profitability and its return on equity measures. It's likely, according to this metric, extending more generous credit terms to clients. What that means is they're being allowed to take longer to pay for products and services, meaning essentially when receivables turnover declines, that means the time it takes for cash to come into your pocket is now longer. In this case, extending from 66 days, I believe, in 2021, 2022, up to 78 days. So the company is waiting longer to get paid, essentially, which is not a good sign as far as cash flow integrity. That. And then next, we move on to return on assets. Notably, from 2022 to 2025, a dip from almost 14% down to 11%. All the while, net income stayed about the same in those 2 years. So the company is relying on a larger asset base to produce the same, to produce a dollar in net income. You see total assets in 2025, 82 billion, 82.8 billion. In 2022, 66.2 billion. But net income is roughly the same in those 2 years. So it could be that with the AI build out, the company is relying on a higher, just has necessarily has is requiring more assets to generate a dollar of net income, and that could be a reality for the company going forward. And then my last ratio would be the return on equity decomposed according to profit margin, financial leverage, and asset turnover. I I like this metric in that you'll notice financial leverage in the center there from 2021 to 2025 stayed roughly even. Um, Slight increase, but more or less the same, meaning the driver of returns on equity primarily comes from operational metrics such as profit margin, or operating metrics such as profit margin and asset turnover. You'll see the dip in 2023 largely came from, almost entirely came from the profit margin, the negative profit margin. And then when you see that it rebounds, that also is largely due to the asset turnover and profit margin metrics, and not so much financial leverage. You will see financial leverage increase to 1.53 compared to a low of 1.33 in 2022, suggesting the company is relying a little bit more on its balance sheet to try and increase that return on equity for investors. Lastly, I've prepared a sensitivity matrix for Micron according to some assumptions that I've explained here. Essentially, I calculated the last 10 years of free cash flow to equity, took the average of the last 10 years, assumed a growth rate for the next 7 years of 20%. 20%, that's a big assumption over the next 7 years. And then a terminal growth rate, which is indicated by the top horizontal axis, anything from 1 to 5% as a terminal growth rate in 7 years' time. And then using discount rates on the far left vertical axis, any discount rate from 7 to 11%. That gives us the range of different values for its company according to those assumptions. I know those are big assumptions. There's going to be broad disagreements on whether one is right or I'm missing something. I know using the average of the last 10 years for free cash flow to equity probably isn't fair given how much has changed in the space. But even if I use just 2025's free cash flow to equity or the last 3 years or 4 years, it's still only slightly, the valuations are still only slightly higher, not exorbitantly higher. So if you see, take my assumptions here, and even if we take the most generous, 20% over the next 7 years, growth each year compounded, and then a terminal growth rate into the future of 5%, which is still well beyond GDP growth long term, and then a discount rate as low as 7%, it comes out with a rough intrinsic value of $132 US in the top right that you'll see in all green. The stock right now is trading as of end of day July 2nd, 2026, $975 US. So, in my opinion, I can't rationally explain how it's trading to such a degree. This goes back to what Jeremy Grantham was saying, and asset prices being perhaps the most expensive they have been in history, with the hype around AI, traditional valuation metrics around companies like Micron, valuation metrics like the DCF, discounted cash flow that I've used here simply don't apply. There must be either something I don't know, something that I'm not aware of, or things really just are that detached from reality. So as far as this company, certainly wouldn't recommend a buy, given it's just so far beyond a traditional tried and true valuation method. If anything, it could be a recommendation to reduce or trim the position, given volatility in the space and just how apparently or supposedly overvalued these companies are. I should disclose this for this video. This is not financial advice. I am not your financial advisor. These are just my